Okay. Okay, then let's move on to our main topic, which is accounting games. So once again, those are our target manipulations which company play around. So let's see how bad companies have deceived the investors and how we can protect ourselves from these bad guys. Okay, so first I will look at income statement, overstated earnings. So the company, when the company play around income statement, we can say two goals, two objectives. Number one is overstate net income, the bottom line, and the other objective, if they have, is overstate operating profits while without overstating the bottom line. So first, I look at this one, and then later on, I look at this one. So how to company overstate this net income? It's just simple. In order to overstate, in order to inflate this bottom line, either overstate the revenue or gains, or understate expense or losses. So this is pretty obvious, right? In order to increase. Oh, by the way, can you see my PowerPoint? Okay, thank you. Yeah. So yeah, in order to make the bottom line better, yeah, either increase revenue or decrease expenses. So far, clear. Okay, then let's look at how the company overstate revenue or understate expense first. So how to overstate revenue? The first tactic is company just record revenue too early, which means aggressive revenue recognition. So this one is maybe timing difference. So they book earlier than they should. Okay, but this is only timing difference. Okay. The second thing is company book revenue, although the collectability is very doubtful. So we have seen this example in NMC Healthcare. So although their allowance for bad debt should be industry average about 8 or 9%, but they only book 2%, right? So they continuously overstate their revenue 6 or 7%, and their account receivable is keep going up, right? Keep going up. Usually those accounts will keep going up. And last one is an extreme case. This is a real fraud. Company book revenue for fictitious sales. Okay, so from here, the bad to worse. And expense case, same thing. The first one just deferring expenses to later years. So this is just the timing shifting. But the company sometimes want to obviously hide the expenses. Okay, so this is how to overstate revenue and understate expenses. Okay, so once again, if you review, company either overstate revenue or understate expenses, they can achieve their goal, which is overstate earnings. Okay, that's fine. But we learned that if company touch this earnings, then it will go to retained earnings in balance sheet. So this earnings will overstate their shareholders' equity balance. So company have to do something to make a balance, to maintain accounting equation. So either over increase assets to make a balance, or decrease liability to make a balance, or decrease other items within shareholders' equity. So out of these three cases, the most common case would be the first case. Overstated asset is the most common case. And the second common case is here. And the least common case is this part. So if companies start this manipulation from revenue, then most likely this revenue will increase account receivable here to make a balance with the retained earnings. If this manipulation game started from this understating expenses, then it will go to either inventory or capitalized costs. So I will look at this one by one. So this first one, I think it's easy, so I will skip. Overstating revenue by overstating account receivable, I will skip. So let's look at what is the understating expense by overstating inventory or capitalization. So let me go back to my Excel. So I used this one before when I teach you about LIFO and FIFO. So if I remind you, the company bought total 4 units. 1, 2, 3, 4. Company bought total 4 units, and now they're holding these 4 units as an inventory. So the sequence is 1, 2, 3, 4. So if company use FIFO methodology, then these 3 units will be taken out as a cost of goods sold. So COGS will be these 3 units, which is $400. If company use LIFO, then this 1, 2, 3, 4, right? 4, 4, 3, 2. The last 3 piece, last in, first out. So this $500 will be cost of goods sold. So after the sales, the remaining inventory value in their balance sheet must be $200 under FIFO or $100 under LIFO. Okay, so it's a pretty obvious. But what if company artificially push only $200 COGS here? Then their total inventory was 600. In any case, if they just use $200 as their COGS, although they sold 3 units, then remaining inventory value, although it's only 1 unit, will be $400. There's no terminology to explain this one. I don't know if you can name it, maybe fraudulent inventory, something like that. So what I'm saying is, if company use lower cost of goods sold, then remaining inventory, the value is overstated. Okay. So back to my PowerPoint.